Excited as Franklin Templeton India embarks on a 4,000 plus kilometer drive from Kanyakumari to Kashmir, celebrating 30 years in India. A first of its kind nationwide campaign aimed at promoting financial empowerment, especially among women. To set the tone for today's event, we'll begin with Change the Soch Kanyakumari to Kashmir drive, insights on India's growth story and broader macro environment. It is my privilege to invite Mr. Avinash Satwalekar, President Franklin Templeton India.
All right, so I'll start a little bit with kind of what the initiative is about, and then walk through a little bit about what Franklin is, and then give some discussion around what's happening in the markets, etc., which I'm sure a lot of people will be interested in hearing at least. So in terms of kind of change the soch, this is something that we've believed for a long time, that we need to have, as an industry, a lot more women in participating in the markets. And a lot of times what we've noticed is that it's not a question of intellect, it's not a question of understanding. It's just a question of kind of getting out of that inertia. Historically, finances have been a male-dominated space. I think that is shifting. I'll give you some stats on just Franklin Templeton's investor base. In Karnataka, 24% of our investor base is women investors. Right? Now that is a relatively small number, and that's something that we need to kind of expand on. So one of the things that we've kind of focused on is, when you look at change the soch, it's the idea of you've got to change the thinking in terms of why is it that women don't feel comfortable or are not part of the conversation when it comes to financial decisions in a house. And this is something that we've found anecdotally, and then the evidence also plays it through. And so part of this drive is to bring awareness, right? And so we've been on the road now for exactly a week and have covered so far 850 kilometers. Done a bunch of different investor awareness programs, mainly targeting rural India. And that's where the need and the change is most required. And that's kind of what we're trying to do right now. 4,000 kilometers plus sounds like a long distance, but India is a big country, and there's a big part of the women investors that need this change in thinking. And I will say this, that some states are ahead of this, some states will need a lot more changing. And so our objective is to essentially drive that thought process, get people to start talking about it, and get, hopefully to a certain extent, get rural India to be a little more comfortable, especially women investors, to start converting from being just good home budget managers into actual investors. Right? So that's kind of what Change the Soch is about. That's what we're trying to accomplish with this initiative. And so far I have to say that we've gotten incredibly positive feedback. What we've noticed also is that a lot of the women in rural India don't particularly know what a mutual fund is either. So this is a massive shift also in terms of just getting awareness of what mutual funds are as well. So let's talk a little bit about Franklin. I know you guys probably know who we are, but I thought it might be helpful to just recap kind of where we are, who we are. We're a 77-year-old global company. We're based in, formed in the US, founded in the US, and as old as independent India is the way I like to think about it. We've got 9,800 employees. We've got over $1.6 trillion in assets under management, and that's across the globe. Right? We do pretty much any asset class that you can think of globally. In India, this will be our 30th year in India. 20% of our global workforce is based in India, and we've got over 24 lakh investors. And a good chunk of our mutual fund schemes have a 30-year track record. So if you see 3 of our funds have a 30-year track record, 75% of our funds have more than a 10-year track record. So why is that important? It's important because our guys have seen cycles, they've gone through ups and downs in the market, especially phases like what we're going through right now, right, where nothing really seems wrong with the Indian story, but the markets don't seem to be recognizing it, and foreign investors in particular have been essentially been massive sellers right across, right? So let's talk about that India story a little bit in terms of why we don't think the India story is dramatically changed from, let's say, even a year or two ago, right? What has changed is obviously kind of the advent of tariffs. So if you look at this, India has the highest tariffs of any country. We're at 50%. The next highest is China, which is 30%. So when you think about what President Trump was trying to do, it was essentially to go after China and the imbalance that the China-US trade balance has. Now, pretty much everybody has kind of gotten into that trap now, where on the margin everybody's going to be doing that, and he very proudly states kind of high levels of revenue that tariffs are bringing in, right? For India in particular, this is a disproportionately high number, and we need a resolution to it. But the actual on-the-ground impact is not as significant as everybody thinks. So if you look at it, exports as a percentage of GDP, for India, total exports is 12%, right? Of that 12%, 9% goes to the rest of the world and only 2% goes to the US. Right, so when you're thinking about it as a percentage of GDP, the impact is not that big for us. So if you even look at 2%, now of that, a good chunk of it is services, which is not impacted by tariffs. Right, so there are a lot of segments and dissections, so that 2% really does not translate to economic. Now, from a sentiment perspective, there is no doubt that unless and until sentiment necessarily shifts on the tariffs, it is unlikely that people are going to start getting excited, and that's part of what we need to see happen. If you look at the Nifty 500 companies, right, 80% of the revenue comes from India. Only 5% of the revenue of the Nifty 500 comes from the US. So even for our companies, the impact is not as significant, right? Now, there's no doubt that even 5% slowing down or whatever it is will have a numerical impact, but it doesn't necessarily dramatically change the fact that 80% is coming out of India. So if India starts to slow down, that is the bigger one, right? So we've got low export dependence. We've negotiated FTAs. I think now the EU agreement is very close. I think from what we can see in the, even just this morning in terms of news, what came out. And I think that will be a positive. So we're shifting away focus from just having it on the US and seeing where we are actually building out our FTA agreements. Monetary support is a big deal. So I'm sure you've seen that in the last 6 months, the fact that RBI has been accommodative is a very positive. Now, just lowering interest rates doesn't get the economy moving and will not be, you won't see that in the numbers immediately. It takes time for that to work through into the system. But it's all, in my mind, very positive, and that's what we are excited about, is the fact that we have an accommodative monetary policy, and we've always had very strong fiscal support, which we should see again in this budget as well. So when you look at, I think the markets are normalizing. So let's see what we're looking at for 2026. Right? We're looking for a bit of a recovery in 2026. The way we're thinking about it is 2026, 2027 is when you will start seeing some earnings recovery, earnings growth recovery. A lot of that will be back-end loaded because it takes time for this to work through into the system. So whether it was the lowering of the income tax thresholds, whether it was the GST adjustments that were done, it takes time to work it through to the system. So we should start seeing a recovery happening in 2026. And so by the middle of the year, you'll start discounting 2027 numbers, which is where we expect the markets will start to get a little more positive. Nominal GDP is going to, I think, continue to show steady growth. We've had very strong numbers across the board. That should continue. That's not necessarily changing. And from our perspective, there are plenty of opportunities across different sectors. The issue always is, what is the time frame? Right? What is the time horizon whenever an investor is looking at it? So, I mean, I know we've been reading a lot about, okay, if you've had investments for the last 1 year, it's not really resulted in any returns. Now, I think it is important for all investors to take a step back and say that your time horizon for investment is not 1 year. Your time horizon for investment should be a lot longer than that, depending on what kind of financial goals you're trying to solve for, right? So I don't think that, now, it's very hard and that's a constant education process. But our view is that anytime India goes through a consolidation phase, which is what it's essentially going through, is a really good time to be investing, right? Can it go down? I can make an argument for it to go down. I can make an argument for it to go up. That is not the point. The point is that anytime the markets seem to be in a consolidation phase, especially when we're talking about foreign investors pulling out money, that money eventually comes back. And it's happened multiple times over the decades. And the argument that India is expensive has always been the case. India always appears expensive compared to any other economy. But India also offers much better growth than any other large economy. So should it be trading at a higher valuation? Yes. Now then we can debate about what is that justifiable premium it should trade at. My view is that in the last 40 years, if you've had a concern around Indian valuations, you've been left out. You've never really invested in the market, because India goes from being expensive to very expensive. The only time it gets remotely cheap or reasonably valued is when we have a global crisis, at which point every investor is panicked anyway. So if you have the wherewithal to invest when that happens, you've done very well. The best way is right now, any consolidation period is when we should be investing. So as far as prepared stuff, that's all I had. I'm happy to answer any questions that you guys have. What are you guys writing about in terms of the markets?
And I want to ask you, this weakening of the rupee, that also adds to the downturn, right?
So
downfall of the market.
Why? Okay, it's a very good point in terms of the weakening of the rupee, right? Why do you think the rupee is weakening?
The dollar is getting stronger.
Actually, the dollar is not getting strong. So if you look at all of 2025, the dollar weakened against every currency. Every is an exaggeration, but if you look at most emerging markets, the dollar weakened against that, right? It's only India where the dollar strengthened against it, and it's not so much the dollar strengthening as much it is the rupee weakening, right? Now you could argue that foreign investors have been pulling out money consistently, and that's the cause. I don't necessarily think that's the only cause, right? There is, in my mind, yes, that puts pressure on, but the lack of clarity on what's happening with tariffs, the lack of clarity in what impact that has on capex investments, that generally leads to a question. Now, see, if you look at the history of the Indian rupee, 3 to 5% depreciation has always happened, on average. Some years you don't have it, some years you have a catch-up. That's effectively what we're going through now, which is a catch-up. So, if you're looking at a investment based on the rupee, right, or the impact of the dollar to the rupee, always factor in 3 to 5%.
No, see, the market right now is very volatile. It's going up and down. Probably waiting for that reactions from the finance minister, the budget coming up next week. So the thing is, should investors actually invest in mutual funds now that you have ETF and all those things which are getting much higher returns? So isn't that a better option?
So when you say ETFs are getting a higher returns, I mean, ETFs are tracking the market. So the markets are not giving you a higher return, the ETF cannot give you a higher return because it tracks the market. Right? So
No, but look at gold and silver.
no, gold is an asset class, that's a different thing.
Okay.
So gold and silver are two different asset classes, just like equity and fixed income and large cap and small cap. Now gold at the underlying commodity has done very well, which is why those ETFs have done well. So if the underlying companies or the equities are going to do well, those funds will do well. So the question is, does gold and silver continue to rally? That is, it's like, think about it, right? 2 years ago, what were we talking about? Small caps. Everybody is saying small caps are up 70%, 80%. We should be all going into small caps. That's the same kind of conversation that you're having now with gold. ETF again, I saw today is hit an all-time high. Silver hit an all-time high again today. Now, anytime an asset class hits an all-time high, you've got to figure out what percentage of that is froth versus real fundamentals, right? So if you're saying that now that silver is giving me good returns, I should be thinking about investing in silver, well, you're kind of late to the party, right? So I still firmly believe that it's a question of having that longer term outlook and making yourself fairly diversified across the board. So if you're in a multi-asset fund, you will have gold exposure. But then the inherent human greed is to say that, well, if I had more than 10% exposure to gold, my returns would be much higher. That questioning of if I had the what if scenario is never ending. The goal should be what? What are we trying to achieve long term? If we're trying to achieve an inflation adjusted return to build wealth for the long run, that is what the focus should be. Problem is we all get lost in each individual asset class a lot of times, and it's very easy to do that because it's hard to say that okay, gold is up nearly double in the last few years and you suddenly get excited. Silver has definitely done a lot better, but is it sustainable is the question. Our view on gold is that there is a shift that is occurring from US dollar assets, and this is at a central bank and globally, into putting it marginally into some physical asset, which is gold. So if that continues to happen, gold will get a bid. Right? So in my mind, gold will continue to stay steady. Right? Now, if central banks tomorrow say, okay, we've got enough gold, well, then your buyer is gone. If your buyer is gone, gold reverts back to traditional retail buying, which does not have the same purchasing power as the central banks buy. So supply demand is essentially what happens. Great starting point. I mean, flexi cap, balance advantage, any of the multi-asset funds, those are great starting points for any investor. So yeah, I would say that would be the one. From the mid-cap fund, we have a large cap fund that used to be called Blue Chip. Long track record, that's where a lot of the asset pool is. But I would say the ones that we are most excited about, we have an India Opportunities Fund, which is now a little over 8,000 crores. And has done extremely well and invests in long-term secular themes that India is benefiting from. So whether it is digital transformation, whether it is premiumization, whether it is energy transformation, those are the kind of long-term secular trends investors.